Good afternoon, everyone. My name is Maurya Hanspal, and in this session, we're going to continue our sessions on value investing. What I'm going to talk about in the previous session, we talked about the various models of value investing, starting from the Benjamin model to net investing, Peter Lynch model, coffee can invest, like till the Peter Lynch model we talked about. And we're going to talk about the coffee can investing. So, what exactly do we mean by the coffee can investing? So, in coffee can investing, basically, it was a strategy, not basically a strategy a stuff like which was being followed in the previous time and is being used for long-term investing. So what happened in the earlier times, the people used to buy the share certificates because this online mode wasn't there. So they used to buy the share certificates and they used to put their share certificates in a coffee can. And once they had those share certificates in the coffee can, they used to put it like below their bed. And after a period of time, the amount rose. That is like they put it under their bed for like certain period of time for 5 years, 10 years, 12 years, and they forgot about it. And once after the 10 years or 12 years or 20 years tenure, like they got reminded, oh, like we have some money. And when they took out the coffee can, the money doubled or like tripled or become 5 times, 50 times. Okay. So that was something like which was being used in the coffee can investing. That is invest your money and forget it. That is something which is being used for long-term investing. But it's completely agreed. Like for the long-term investing, the strategy will work good, but the strategy will only work good if you are investing into the strong companies. That is a fundamentally strong companies. If you just don't keep your money into like just random companies and forget it, you just keep your money like into some random companies which are not fundamentally strong and you just forget it. So it can create a problem for the portfolio, right? So this coffee can investing is basically which emphasize on the thing of long-term investing. If you are a long-term investor, then invest into those companies which are strong, which have the fundamentals. If the companies are not having fundamentals, no need to invest in them. Okay, otherwise, this coffee can investing principle won't work. So that you need to understand. Because in the long term, like what basically happens in the long term on a CAGR basis, the market tends to be stable. In the long term on a CAGR basis, the market tends to be stable, and that you need to understand. Okay, that was the Ray Dalio's all-weather portfolio. So like there is a person called Ray Dalio, and he's like the great persons, one of the great persons in case of the hedge fund. Like he's one of the greatest hedge funds manager. So what do we mean by hedge fund? A hedge fund is basically which includes like various kind of strategies using options, futures, derivatives, so has to hedge you against the market. ताकि तुम्हारा loss now. So he basically said that he is creating a portfolio which is best for all the scenarios. That is, he is taking keep 30% in stocks, keep 15% in mid-term bonds, keep 40% in long-term bonds, keep 7.5% in commodities, and 7.5% in gold. So he said that this will be the best portfolio, and this portfolio will be best in all the scenarios. That is like whether the market is in a period of boom or whether the market is in a period of recession, this portfolio will work well. But in the present scenario, this portfolio might not always work well because the times have changed and the market dynamics have also changed. Okay, so that can create a problem. So see, like when he's investing the larger chunk in stock, the stocks are the most risky asset. So he might be concerned about the capital appreciation and growth here, right? Further, like he might in the long-term bonds and interim bonds, like he might be concerned about the fluctuations of the interest rate. Because when the interest rates are expected to rise, people shift their investments from long-term bonds to short-term bonds. That is, they sell the long-term bonds in the market and buy the short-term bonds. Whereas when the interest rates are expected to decline, they sell the short-term bonds and buy the long-term bonds. And that we popularly call it as a dynamic fund. Then, then talking about gold. Gold is again a hedge against inflation. Because at the times of inflation, the value of your money remains stable because the price of gold rises. And also in terms of recessions and all, as we can, the geopolitical tensions and recessions, as we can see in the case of the Russia-Ukraine crisis, the value of the gold appreciates. And especially in these kinds of crises, the commodities also appreciate because there's lack of supply and more demand. Okay, so that was the Ray Dalio's all-weather portfolio, and he might have thought about all these scenarios. Okay, then there was one portfolio called the Golden Butterfly portfolio. What basically happened in the Golden Butterfly portfolio? He said that 20% of stocks, 20% in small caps. And why small caps? Because small caps have a potential to outperform the large caps. Because over the time, the small cap index and the mid cap index have outperformed the large cap index. The long-term bonds and short-term bonds, I told you why. Because when the interest rates are expected to rise, people sell their long-term bonds and buy their short-term bonds. And when the interest rates are expected to fall, people sell their short-term bonds and buy the long-term bonds. Then gold again, it's a great hedge against inflation. Okay, so that you need to understand. A great hedge against inflation. Then they talked about the pinwheel portfolio. So it was a kind of a portfolio which basically suggested the certain division of the commodities. Okay, so basically it was there that 10% must go in gold, real estate investment funds 15%, in REITs. We call them REITs, in which like you get units and you get the benefit of both the capital appreciation and dividend. Because at least 80% of the amount is invested into commercial properties. Okay. And 90%, at least of the 90% has to be distributed to the investors as dividend. So like 50% in the real estate investment trust, cash 10% rakho as a liquid cash, international US bonds, like so that the people can take the advantage of the interest rates. Emerging market stocks 10%, because again the emerging market stocks also have a very great potential. Okay, because they tend to outperform the developed markets. Then international stocks में 15%. And why international stocks? Because there you can get the benefit of diversification. You can even buy units. Again, the small cap. See, and this US now, this US can be India, because like this person like lived in US, and that's why like he said US. It can be the Indian stock market, US small cap, Indian small cap, and international funds can be in terms of US and all. Okay, so that thing you need to understand. So like whenever you are like investing into US stocks, so people can buy the fraction of shares. The fraction of shares can be bought there. And also over the time, a rupee has depreciated against the dollar. And we all know that over the time, a rupee has depreciated over the dollar. That is again like where you get the benefit of the foreign currency exchange as well. Because when the dollar gets converted to rupee, you people can get a good amount, because ultimately your earning would be in dollar. Okay. So that thing you need to understand. These were like some of the suggested portfolios, like which were made by different persons. Okay, that is like which were suggested by different persons. Okay, so I think the concept of the value investing is completely clear, and the perspective of the value investing can differ for different persons as well, like on the basis of the behavioral finance as I talked about.